I was asked recently about the European securities that we hold in a client's portfolio, and this client was particularly worried about a possible and maybe even an imminent significant decline in the value of the euro. They were worried about what effect that might have on their holdings. So I thought this might be a really good time to revisit why we actually hold equities denominated in currencies other than the Canadian dollar. The first thing to note in the issue is that we don't hold those securities because we expect a favorable move in the Canadian dollar exchange rate. Currencies typically move 3 to 4% a year on average, and over the time period that we would expect to hold our investments, any move that's attributable to the currency is really likely to be very minimal. That's the other reason that we don't hedge those exposures, is because the cost of hedging is just simply not necessary if you have an appropriate time frame on your investment. The reason that we invest outside of Canada is to get exposure to companies that do business in different geographic areas, and particularly in different industry sectors than you can get by simply buying companies that are domiciled in Canada. The TSX is roughly 70% made up of financials and commodity-oriented stocks. It's very, very difficult to find world-class companies that are doing business in the area of healthcare, for example, or in consumer discretionary spending in Canada. So the rationale for investing outside of Canada really has very little to do with the fact that you're taking on currency exposure, and really everything to do with the diversification and the benefits that accrue to your portfolio, because you have access to different geographic areas of business and different industry sectors. So what does that mean in the context of my client's question about the euro and a possible significant move in the value of it? I guess my first response to that is that if I thought that anybody could proficiently forecast where a currency was going to go, or in what direction a currency was going to move and in what time frame, I would suggest that they try to create their returns by running a currency fund and forget about all the painstaking research and whatnot that goes into choosing companies and investing in businesses. History, though, has shown that there are very, very few people that are capable or are proficient at market timing over a consistent period of time, and that's really in the venues of currency, equities, fixed income, commodities, you name it. It's a very, very difficult thing to do, and there's significant investment research that would suggest that it's difficult to do. A number of those research pieces are accessible on our website under the investor education sector. What is possible in the world of investment management is to consistently identify companies that have competitive advantages, that have excellent management teams that execute their business plans, that have low levels of leverage, and that generate significant free cash flow. So the advice to my clients with regard to their question about the euro would really be to not try to capture short-term gains or to avoid short-term losses, but to do the things that you can consistently do well over time. Structure your portfolio appropriately and diversify across geographic and industry lines, and your portfolio will meet your objectives over time.